Best 3 stocks to buy in the stock market right now. This is my second video of my new series of me discussing 3 or 4 stocks that I believe are the best buying opportunity in the stock market right now. The best setups for the short term, but could also be pretty good long-term investments. Best risk-reward opportunities where if I had cash, I didn't own any stocks, I had to pick 3 or 4 of them. These are the stocks I'm going to pick. I have 2 of them. They're more well-known large cap companies, boring stuff. The third one is a very interesting company trading at 11 times earnings, 9% free cash flow yield, very good dividend, competitive advantage, a moat. It's located in an area or in a kind of sector where it has pretty decent growth, pricing power. For 11 times earnings is dirt cheap. And I think you guys are really going to enjoy this kind of analysis. Okay. Now, for my last video, I did discuss some stocks. I discussed PayPal. PayPal went up and came back down. I discussed BMY. BMY is still pretty much flat. Not all of them have played out, but so far Bird has been playing out. And Bird is up 23% in 1 month from this video. Absolutely insane. When I bought it in March and I'm up 52%. And it's been just too cheap to ignore, and it's still like 11 times earnings. So you could go back and watch this video, and I still believe the stock is undervalued. But for this analysis, I'm going to focus on boring stocks. And I personally seeing an opportunity in the boring quality kind of just dividend stocks. And I'm not a dividend investor, and I don't normally buy, something like McDonald's and hold for 20 years. If you do that, this is your strategy, it's fine. It's not my strategy. As you guys know, I focus sometimes on shorter term setups and things on bad sentiment, sells them a good sentiment. And in the market, we have something called rotation. Most of you are familiar with that stuff. So there's only so much money in the market. The market gets excited about a certain sector and it punishes another sector. It punishes certain stocks. And you could look at this chart. McDonald's is down 16% year to date. It hasn't happened since 2009, I believe. I looked at the data. Pepsi is down 4%, UNP down 8%, Starbucks down 14%, and NOC, which is an amazing defense company, is down 9% year to date, while Nvidia, a lot of the other stocks are making new highs. Now, maybe those stocks, they deserve to go down for certain reasons, but I personally believe they went down more than they should, and this will ultimately change. And the first stocks that I have for you from this boring list is a stock called Pepsi. I've been in and out of Pepsi many times. Last time, like a few months ago, I mentioned on YouTube I was buying Pepsi. I did buy Pepsi at 165. Pepsi went to 183. It was up like 15% in 3 weeks or 3.5 weeks. And it's been so many times I get in and out of Pepsi because it's a very predictable stock. People get excited about tech. Pepsi goes down. It gets too undervalued. You buy it, then it goes up, then you sell. And this is what I do. I get in and out of Pepsi. I don't hold Pepsi for the long term. And now I bought Pepsi again after I sold before at 163. And I'm planning to do the same thing. And if it goes down, then I just buy more at the dip and just hold a good company. But Pepsi, even for the long term, I'm seeing a good opportunity here, and the short term also, down 7% on the month. I don't have to introduce Pepsi to you. You're most likely familiar with the brand and with many different, Doritos, Cheetos, Lay's, and a lot of different brands that they own. They even have a stake in Celsius, which a lot of you enjoyed my videos. I think they own 8.5% or 9% of Celsius. So you're also getting exposure to this brand if you're investing in Pepsi. What I like about Pepsi versus Coke is it actually has a little bit more exposure to convenient food, a lot of the snacks. So if maybe a lot of the drink consumption is declining, so does a lot of other kind of food could be increasing in organic growth. And this is why I like this company very, very much. But in terms of its setup, now Pepsi is trading at 20 times earnings. Now, if you look at the line I'm showing you over here, on a historical basis, over the last 10 years, 20 times earnings has been an amazing time to be buying Pepsi. It has bottomed many times around 19 to 20 times earnings. And this is where Pepsi stock is trading at right now, at a historical bottom. The lowest it has traded at over the last 10 years was around 16.7 times, around 17 times. And it went to 17 times, I believe it was on the sell-off in 2018, and also went there in March 2020. But in March 2020, it went to 18 times. Now you're buying it at 20 times. And on a historical basis, this has been a good time to be actually buying Pepsi. Now, a lot of people on Twitter, they tell me Pepsi should be trading at 10 times earnings because it has no growth. But it's not just about growth and dividends. It's not really about that stuff. It's more about the company itself. This is more of a safety company. It has a competitive advantage. It has amazing pricing powers. They can always raise prices and consumers will take it because they are loyal to the brands that Pepsi actually has. and it has a moat, it has a competitive advantage. It's more of a, as I said, safety stock. Even though it has a balance sheet, they can refinance a bad balance sheet and the debt. And I mean, they have good credit rating, and it's a free cash flow machine. So this is why Pepsi will never trade at 10 times earnings. And it took me years to understand this, but this is just the truth. Even COVID could not take Pepsi to 15 times. It took it to 16.7 times, or around 17 times it was. So this is what I have with Pepsi. For the multiple, it's looking very good on the short-term basis, but for the long term, the company is targeting high single digits in earnings per share growth. And I believe this is extremely achievable because the company can raise prices even though volumes could be declining in certain products that the company is selling. But in terms of the analyst expectations, they expect 10% for 2025, then between high 7 to 8%. So I would say 8% on average. So we're getting an 8% return in terms of earnings per share growth, but you're also getting a 3.2% dividend. So this is pretty close to an 11.5% annual return on Pepsi. But you're also getting a potential multiple expansion. For a multiple expansion, now it's trading at 20 times. Over the last 10 years, the mean was 22 times. Over the last 5 years, the mean was pretty close to 24 times. So you're getting around 11.5%. I would call it more of a yield. Like let's say I had a dividend stock, I'm getting 11.5% to hold Pepsi, which is a very safe company. But I'm also getting a potential multiple expansion, which could put my returns around 12 to 13% annual return on a safe company like Pepsi. To me, it's amazing if you are a long-term investor. But if you're more of a shorter-term oriented like me, for example, I'm parking cash in Pepsi at $163. It's hard for me to lose money with the stock. If it goes down, I'm going to buy more. It's not going out of business. And it's going to raise prices, going to grow 8%. I'm getting my 12, 13% a year yield, worst case scenario. Best case scenario, Pepsi works out again, like it did for me over 10 times. And I make 15% in a few weeks or a month or two. When the sentiment changes, Nvidia pulls back, Pepsi and McDonald's and the safety name go back up when people talk about the recession. So this is what I'm seeing with Pepsi. It's a very good setup. The second stock, which I'm really liking in the short term and also for the long term, is a company called NOC. And I know NOC, some of you may skip it because of maybe ethical reasons or moral reasons, and it's fine. I could put up the time on the screen and you could skip to the third stock, and it's completely fine. But I'm fine with the company personally. And NOC it's an amazing defense contractor. It's down 9.4% year to date. And it's not very often you get such sell-offs. Even in the short term, you look at it, it has historically bottomed around this level from 2022. And I did buy it and I sold it before. It was mainly in late 2023. I did the same thing. And it's looking good for me over here. NOC at $425. It is looking good in the short term, but the last earnings report was absolutely stunning. The company grew sales 9%. It grew earnings per share 15%. Free cash flow is still on track. I'm going to talk about it. They did buybacks. They did dividends. They returned 100% of the free cash flow back to shareholders. It's an amazing dividend grower for a lot of dividend investors. And the company has $79 billion of backlog, which I believe is around 2 years worth of sales. So $79 billion. And the backlog has been sustained and it will most likely grow, as I'm pretty bullish on defense personally for the next 10 years. I see what happened in the geopolitical space recently, and I see NATO and the United States, they're going to be increasing defense spending because of the uncertainties that's been happening. And I think those stocks will ultimately trade at a premium, and they're not currently trading at where I believe they should be trading. A lot of people are looking at them and they say, oh, it got a premium from whatever happened in Ukraine and now it's pulling back. It's going to go back to what it was in 2015. I don't think so. I think this is a new era for the defense stocks, and I think they will be trading at higher multiples than they traded before. This is my thesis. But for NOC, if you're buying NOC today, you're getting a 5% free cash flow yield. Very good. It's a pretty good free cash flow yield. And as I said, they return 100% of it back to shareholders. They do buybacks, they do dividends. So it's a 5% yield if you're buying NOC today. But the best part about it is this free cash flow of 5%. NOC is guiding 15% CAGR of growth from 2024 to 2026. So going into 2026, you're getting the 5% free cash flow yield. And this free cash flow is expected to grow 15% CAGR. And this is because NOC spent a lot of CapEx, and they expect lower CapEx starting in 2025. And once CapEx pull back, cash from operations should still be good. That's going to increase free cash flow. And they expect 15% CAGR On recent updates, they were very comfortable about this target, and they are meeting the free cash flow range for 2024. So the 15% CAGR is on track. So you're getting the 5% free cash flow yield. This free cash flow yield is expected to grow 15% for an amazing company with a backlog. It's not going anywhere. It's always going to be here. And you're getting it at a discount. For the multiple, it's trading at 19.7 free cash flow. The mean over the last 3 years was 26 times. And again, a lot of people will say that this is because of the Ukraine war, which maybe is true. But if you look over the last 5 years, the mean was 22 times. So you're still getting NOC at a discount. So you're not only getting a 5% free cash flow yield, you're getting a 5% free cash flow yield, growing 15% CAGR, and you're getting a potential multiple expansion from 19 times back to 22 times. But I personally believe that, again, this is a new era for the defense companies. The defense companies are going to be more and more innovative and are going to get more and more contracts from many different countries. And I don't believe it's going to be as low-performing, boring industries that it used to be. I think this is a new era for defense stocks. I'm very bullish on them over the long term. And I'm not saying the stock is going to trade at 38 times earnings, going to trade at 35 times free cash flow. But I could easily see the stock going back from 19 times to around 26, 25 times free cash flow with all the uncertainties that's been happening and the increase in defense spending. But if that didn't happen, the worst case scenarios that I'm seeing with NOC is whatever the analysts are guiding of around 5% revenue growth and 5% free cash flow yield. Worst case scenario, this is a 10% annual return. So this is the kind of setup I'm seeing with NOC. But I see it more of a 15 to 17% annual return for the next 5 years with a blue chip kind of stock like NOC. It doesn't happen very often with an amazing backlog. So I love it over here. And I think the stock is very undervalued. And I see it as a very good opportunity. Now, the last stock I'm going to talk about, which I've never discussed before, is a stock called KOF, Coca-Cola FEMSA. Maybe some of you are familiar with the stock because Bill Gates, I believe he still owns it. He has a pretty decent stake in the company, and it's down around 7.8% year to date due to the many different things. Mainly a lot of things that's happening in Mexico with the new elections. They got a new president, a lot of uncertainty around the policies and the changes in government, the things that's going to happen. You also have a weaker peso against US dollar. A lot of that stuff is putting pressure on KOF. But I believe this is, one-time pressures or temporary pressures, I should say. I don't think this is going to last for the long term. And it's causing a sell-off in it. But for KOF, it's an amazing company, a bottler for Coca-Cola. And if you're not familiar with bottlers, I would encourage you to watch Mohnish Pabrai's video. You could put up Mohnish Pabrai Coca-Cola, and you get this 2-hour lecture. It might look too long or might seem too long, but I promise you, you're going to learn a lot. I learned a lot from this lecture around the bottlers and how Coca-Cola works and how Buffett bought it, how much he paid. It's amazing, amazing knowledge. I love this video. But for the company, they are positioned in a key area, which is mainly in Latin America, in Mexico, Colombia, Argentina, Uruguay, Brazil. And the key is that these kind of markets, they have good demographics. They still have population growth, but they also have an increase in consumption in terms of such drinks. In the United States and in Europe, such drinks are mostly shrinking. But in these areas, especially in Mexico, most of you know the Coca-Cola over there, how popular it is. And it just keeps growing in volume. So you're having pricing power and you have an increase in volume. Pepsi is facing a decrease in volume and they have to increase prices. But something like the bottler, which actually dictates the price of the bottles you pay. They get the syrup from Coke and they dictate the price. So they have pricing power, but they also have volume. And this is amazing, amazing stuff. And they serve over 270 million people, 56 bottling brands, 249 distribution centers. Just absolutely stunning. Over 134 brands. I mean, it's just amazing stuff. You look at the last quarter, volume increased 7.3%. This is unheard of. All the beverages kind of stuff are decreasing except energy drinks. And this one is putting up 7.3% increase in volume. Total revenue growth was 11.2%. Gross profit growth 11.7%. Operating income 11.6%. It did very well in terms of COF. And it's positioned in an amazing market. But if you look at the free cash flows, they had a lot of one-time expenses, a lot of different things. And this is why it's $666 million for 2024. But it's expected to rebound to $1.5 billion or $1.6 billion, close to that, in 2025. Now, if this actually happens, you're buying Coca-Cola FEMSA around a 9% free cash flow yield. And I believe it's very possible. Now you're buying the 9% free cash flow yield and with revenues growing of around 8%. So you're getting a 9% free cash flow yield with 8% revenue growth at 11.9 times earnings. And can you believe that? I mean, it's absolutely insane. It's the lowest it has traded at over the last 10 years. It had traded at before. It was an amazing bottom. Then the stock rallied like crazy, and then it came back down. But it's trading at the lower end of the range, as you could see on the slide, 11.9 times earnings. For 9% free cash flow, 8% revenue growth, for a company that could not be replaced. You would have to build all the distribution centers, all these things, unless Coca-Cola leaves them, which they have contracts for 10, 20, 30, 50 years. It's almost impossible. So it has a moat, it has pricing power because they dictate the price of the bottles that you buy in the store, and they have a good market, population growth, and the good consumption volume is increasing for such drinks, recession resistant, at 12 times earnings. The mean was 18 times. I mean, I just think the stock is undervalued. And the only thing is maybe you could have something in terms of the new government, maybe some regulations, some price caps or something. I'm not sure what's going to happen. This is why the stock is selling off. But to me, it looks like it's way overdone. And I'm just seeing an amazing opportunity with KOF. And I'm still researching it, and I'm considering it for my own portfolio. It looks very interesting, very undervalued, and I really like it over here. My favorite one is maybe NOC, and then Pepsi. You know, such two stocks are good for the short term, or if you're bullish like me on defense for the long term. And KOF is just too cheap to ignore. It looks pretty amazing. And this is my picks for this month of the best 3 stocks to buy in the stock market right now. Of course, don't just go and buy the stocks, do your own research. Maybe I'm wrong. I've been wrong many times before. And it's not financial advice, just my opinion. So thank you again for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.